Making Money with ALP, Part 1. Hello everybody. We will be today talking about making money with the automated lease purchase system. We'll be discussing how to make money with the ELF system. The ELF system profits are available in 3 ways. Number 1 is when signing the contract. Number 2 is throughout the contract. Number 3 is upon the sale of the property. So number 1, the option fee, which is received on the signing of the contract. When you sign the contract, you receive a consideration, which is an option consideration for the option to purchase agreement, which means the tenant buyer is giving you the deposit for considering to sell him the house in 1 to 3 years at a certain amount which is agreed in the contract. The tenant buyer pays this money as the initial payment when concluding the leasing option. Some people call it a deposit option and refuse to call it a deposit option because similar terms are applied in the normal agreement of purchase and sale. So you think that calling a deposit might have some legal applications, as the deposit can be refundable. Yes, it can be. So in contrast, an option fee is an option consideration which is technically non-refundable. So depending on the contract we normally use is lease option fee instead of just the deposit. So number 2 is throughout the contract. Typically contracts allow you to make money throughout the contract because you receive more money than you're paying for your mortgage, property taxes. If you're leasing, then it's for your lease because you may lease and then sublease it to the tenant buyer. So depending on how long you wish to conclude this contract to the option agreement, the contract is normally 3 to 5 years. Normally we conclude the open contract for 3 years, which means the tenant buyer will buy the property within the 3 years. So there could be an amount which we add as our monthly profit on top of the mortgage payment, property taxes, and insurance. And this is discussed openly with the tenant buyer because we are helping them get a house in which they are going to be living. So it can be a few $100s depending on the property and the investment amount and the situation of the tenant buyer. So number 3 is upon sale of the property. When you sell a property, you get money in the LP system because each year the appreciation is added. So, which is added to the purchase price. The return profit is the difference between what you purchased the property for and what you're selling it for. For instance, the difference can be between $45,000 to $100,000 depending. Let's say you bought the property for $300,000 and you're selling it for $345,000, so then the profit is $45,000. If you structure the deal correctly, you can make a lot of money with the LP system depending on the agreement. Normally I make anywhere from $30,000 to $100,000 per deal. We'll discuss the 3 ways in the following in detail. So let's discuss what kind of profits can you expect at the term of signing the contract. Remember, money is made when you purchase the property, not when you sell it. You realize it when you sell it. So in every possible way in our ALP system, we try to make the money up front. So this gives us an added security. So let's discuss that going forward. As we discussed, the first way to make money is through the option fee, which is option consideration. The cash that your tenant buyer puts when entering into the agreement, the amount required for the deposit or the option fee differs significantly from the standard renter amount a normal tenant pays the first and perhaps the last, or the security deposit. But when you are doing an ALP lease option agreement, you are almost taking like 6 months to 1 year of payments as the deposit, which helps you in getting the added security. So when you use the ALP system or the agreement, the deposit is usually called the option fee, and which is a considerable amount. It can range anywhere from $15,000 up to $70,000 or even $80,000 we have seen in our contracts. The tenant buyer can purchase the property for a specific amount using this consideration fee. And that's why, because we are giving this option, we want this option fee to be considerable so that they don't pull out easily and that they are serious about purchasing the property. And they are not just renting the property, but they will be purchasing this property. And that's why this option consideration has to be reasonable. A lot of rent-to-own people means other companies who are doing the rent-to-own, they make this mistake. The option fee is meager, like option fee is $2,000 or very small amount, and the tenant can change the mind at any time and just forgive this $2,000. And then as an investor, the investor stands too. But in our case, we pay very special attention to make sure the tenant buyer is serious in getting into this contract and is paying considerable amount to stay in the contract and to eventually purchase the property. Let's say the house that you are buying for the tenant buyer, or you already own that house, or you are thinking of leasing it and then getting it under the option to purchase and then doing the subleasing and doing another option to purchase, which is called sandwich lease. If you are doing that, we'll be talking about those techniques down the line, but don't worry about that at this moment. So let's say the house is for $300,000 and you agreed with your tenant buyer that they will buy it within the 3 year for $345,000 or in 3 years. If you use the ALP system to structure the purchase, the tenant buyer has the option to buy at $345,000, giving you an option consideration fee. This option consideration fee is normally 5% or more, so the tenant will end up paying you about $10,000 to $15,000, normally due to the hot market and due to the increased risk these days. Due to COVID-19, we take minimum option fee of $20,000, and this kind of gives us an added security. You might be wondering and thinking, why would somebody pay you $10,000, $15,000, $20,000, or $30,000 or $50,000? Why can't they just go and buy? And I can tell you the majority of the cases, it varies from case to case. And let's say, for example, a customer has $10,000, that's not even 5% of the $345,000. Majority of the banks will require 5% to 20% deposit, depending on your credit history, depending on their current situation, depending on all their current status, and especially due to COVID and this global pandemic, majority of the lenders want at least 10% to 20% of the down payment. Sometimes they're giving you, let's say, 10% or even 20% of the down payment or 15% of the down payment. And their situation might be such that, let's say, they booked a property from the builder a few years back and they put a 10% down with the builder. And now at the time of purchase of the property, for whatever reason, they are not qualifying for a mortgage. Maybe their job has been cut down or the income has been reduced, or they are going through some personal problems like divorce or any other situation where they're going through such problem and they are not in position, or their credit rating has recently got a hit and got some collections or some problems. They cannot qualify, or they don't have sufficient or good enough credit to qualify for a. So even if they have 20% down or 15% down, they're still not able to purchase the property. So in those situations, it's better for them to do a ALP lease option than to let the deposit go or let the builder forfeit the deposit. Many realtors or rent-to-own companies which are not too familiar with the system is they take the option fee as a deposit, and they would normally sign an agreement of purchase and sale with an extended closure or delayed closing. which can be 3 years or 2 years, and where it's considered this is as a deposit. The problem with that is, for example, it says within 3 years the tenant buyer is going to buy the property for $345,000 and down payment is received as the closeout deposit. The problem is that now you have to keep that deposit in the trust account, in the lawyer's trust account, or if you're using a realtor, then you attest to real estate brokerage trust account, depending on your jurisdiction. And if it's a down payment instead of an option, it appears as it appears in the agreement of purchase sale. I don't think we should do this kind of contract. The reason for that is very simple means. If you are not receiving the option fee, you are just receiving the deposit, why would you hold the property for someone for 3 years? Why should you give someone an option to purchase the property in 3 years when it's only the deposit, not the option fee? Option fee is non-refundable. Deposit, you might have to refund it. In that case, if the cash in the trust account is in the trust account, it's going to be very hard for you to get it from real estate board or real estate brokerage, and it's going to be an uphill battle for you to fight back to get that deposit. That's why take that risk? So normally, as under ALP system, this is simply considered as an option fee where the tenant buyer pays you the option fee directly under the contract, and this is an option fee which is non-refundable. It's very important to mention that this is non-refundable because it will have tax implications on your income taxes, because if it's a non-refundable deposit, then the transaction will be considered as capital gains. If it's a refundable deposit, then it will be considered as normal agreement of purchase and sale. So it's very, very important for you to understand that. And on top of that means once you get the cash, it helps you with the overall cash flow and the profit. So the next is, throughout the contract you make money, and the way you make money is because the amount that you're receiving as your rental income and the amount that you're paying as your mortgage or as your property taxes, the income exceeds the expenses. Or even if you're doing a lease option, so it's more than your lease. So the difference becomes your cash flow and the profit. And on top of that, you get an added profit for yourself, which is normally included in the contracts. And also there is what we call the additional rent. The additional rent is the savings, a kind of boosted savings that we do for the tenant buyer, which also acts as your additional rent. So yes, down the line you will have to refund it, but it's a good amount of time. It's roughly 2 to 3 years where you will get to use those funds for any other investments or down the line, because all this additional rent and the extra funds that you receive, which you need to refund, you can pay it out of your profits in the deal already. So you're being paid in advance for the appreciation that's happening in the property, which is a fantastic way because you don't have to refinance it. You're already receiving the payments up front. Of course, you can go ahead and refinance it as well because the property is in your name. Yes, you can take out an equity if there's equity, or we would suggest taking that out and reinvesting. And so I think this is a fantastic way to get the extra cash flow in hand. On top of that, it helps you with when you're refinancing or when you're buying the next property, because of the added extra income that you have, it becomes your qualifying way simpler because you have more income than expenses. So it adds on to your income and the normal rent to own. Or in these option, the result is opposite because the income hardly covers the expenses and you're just making maybe $102 to $100 more. But because the banks or the lenders do not calculate the full income, as the income. So what ends up happening is that each property that you buy becomes a burden rather than an asset in terms of the lender. So it makes your purchase of the next property very, very hard in those cases. So that's why under the ALP system, we have designed it totally differently, where each property that you buy will make it easier for you to buy the next property when you own a property.